All right, welcome. Today we are diving headfirst into a classic market showdown. You've got two of India's biggest tobacco players, and they're both facing the same massive new tax hike. This whole situation has really set the stage for a fascinating battle: GPIL versus ITC.
So, the big question on every investor's mind is pretty obvious, right? In this new high-tax world, where do you put your money? Do you go with the established, undisputed market giant, or do you bet on the smaller, more nimble challenger? Let's kick things off by looking at the sheer scale of this matchup.
And wow, we're not kidding when we call this a David versus Goliath setup. I mean, just look at these numbers. On one side, you have ITC, an absolute behemoth worth over 4 lakh crore, controlling a staggering 80% of the market. Then on the other side, you've got Godfrey Phillips, or GPIL, a much smaller challenger at around 31,000 crores, but still holding its own with a very respectable 14% share. The difference in size here is just immense.
But this fight is about way more than just size. It's really about strategy, about identity. So let's take a closer look at what actually makes these two titans tick.
Okay, so what's really interesting here is how fundamentally different these two companies are. You see, ITC is this massive, diversified conglomerate. Yeah, cigarettes are huge for them, but they're also in foods, paper, agriculture, you name it, and it's all run by professional management. GPIL, on the other hand, is a pure-play tobacco company. It's family-owned, and its crown jewel is that exclusive license to sell Marlboro in India. We're talking two completely different game plans here.
So how do these very different strategies actually stack up? Well, let's break it down and look at the numbers with a head-to-head scorecard.
And you know what? I'm not going to make you wait till the end for the result. Based on this really comprehensive analysis, there is a clear winner. As you can see right here on the scorecard, ITC takes the top spot with a commanding score of 83.5, while GPIL comes in with a solid but definitely lower 67.5.
The final verdict from the report that we're looking at couldn't be clear. ITC wins. But, and this is a big but, the story definitely doesn't end there. The real insights, the juicy stuff, is in why it wins, and more importantly, where the challenger, GPIL, actually manages to land some pretty serious punches.
And here is the first big punch from our challenger. In the absolutely crucial category of growth, GPIL actually comes out on top. It scores an impressive 17 out of 20, easily beating ITC's 14. This right here is GPIL's key strength. This is its knockout power.
But hold on, the champion strikes back immediately. When we start talking about balance sheet strength, ITC is just in a league of its own, scoring a near-perfect 19 out of 20. This is what you call the financial muscle of a market leader on full display.
And this really brings us to the heart of the debate for any investor. It's a classic trade-off. Do you bet on GPIL's explosive growth, or do you go with ITC's untouchable, fortress-like financial stability?
So just how explosive is GPIL's growth? Well, get ready for this number: 36%. That's its 3-year compounded annual growth rate for profits. I mean, that is an absolutely incredible figure that makes it a real standout for any investor who's hunting for growth.
But how do you possibly compete with something like this?
A perfect score.
ITC gets a 9 out of 9 on the Piotrowski F-score. And for those who don't know, that's basically a financial health report card. A perfect score means you are in the absolute strongest financial position possible. It just doesn't get better.
And this slide just illustrates what that perfect score actually means in the real world. ITC has a top-tier AAA credit rating. It has basically zero debt. It's generating a massive 15,000 crores in free cash flow every single year. And on top of all that, it offers a very attractive 4.3% dividend yield. It's a financial fortress, plain and simple.
So far we've got a classic growth story versus a stability story. But, a smart analysis always looks at the risks. So let's decode the red flags for both of these companies.
And for our high-growth challenger, GPIL, there is one that really stands out, a major red flag that investors absolutely have to understand before they even think about putting money in.
It all comes down to a little thing called the CFO to PAT ratio. That sounds complicated, but it's not. All it does is show if a company's profits on paper are actually turning into real cash in the bank. You want this number to be close to 1. It's a super important sign of healthy earnings.
And here's the problem for GPIL. Their ability to turn profit into cash has just collapsed. It's dropped from an already kind of weak 0.33 down to a critical 0.10. So what that means is, for every single rupee of profit they reported, only 10 paise actually became cash. That is a serious concern about the quality of their earnings.
Now let's be fair, ITC isn't without its own risks. But notice the difference here. These are more like watch items than screaming red flags. You know, things like the potential for its biggest shareholder, BAT, to sell more shares, or the fact that it's still heavily reliant on the cigarette business for profits. They're definitely risks, but they're just not as urgent or as acute as GPIL's cash flow problem.
Okay, we've seen the strengths, we've seen the weaknesses, and we've definitely seen the big red flag. So let's bring it all together for the final verdict, and more importantly, some actionable takeaways for you.
So what's the final call from the judges? Well, the analysis recommends accumulate for ITC, but it says hold for GPIL, suggesting you should only really buy on dips. The report even gives us these strong buy zones. Anything below 280 rupees for ITC and below 1700 for GPIL is where you'd be getting a much better margin of safety.
Let's just simplify this into a really clear playbook. Are you an investor who's looking for safety and a steady dividend check? Well, the analysis points you squarely towards ITC. But are you a growth investor who's willing to take on a bit more risk? In that case, GPIL is the one to watch. But patience is absolutely key. Waiting for a better entry point seems to be the smart move.
You know, this quote from the report just sums it all up perfectly. ITC is a financial fortress that's just dealing with a temporary problem, this new tax hike. But for GPIL, yeah, the growth story is exciting, but given those cash flow concerns we talked about, patience is absolutely warranted.
So the final takeaway really is this clear trade-off. With ITC, what you're getting is a superior margin of safety. It's the safer bet. With GPIL, you're looking at a higher risk proposition, but with that risk comes the potential for a much higher reward if they can sort out their issues.
Which leaves us with one final thought, right? Look, ITC is the clear champion in this head-to-head analysis, for now. But we all know the market never stands still. The big question to watch is this. What happens if GPIL fixes that cash flow problem? Could that powerful growth engine of theirs roar back to life and actually challenge the king for its crown? Now that is what makes this tussle one to keep watching. Thanks for joining us.